Greeting everyone, my name is Karen Chiang, YING matrix number 261217. Today I'm going to discuss about the case 5 pages regarding the Caribbean Brewer, the transfer pricing, ethics, and governance. So before we move into the question, let me brief you all regarding the organizational structure. So there is three corporations in this case, which is the CHIA International, the Caribbean Brewer, and the CHIA Caribbean. Two of these corporation actually is a subsidiary of the CHIA International, which CHIA International owns 75% of CHIA Brewer and full ownership or 100% for the CHIA Caribbean. Okay, first question. How can the majority shareholder shift with through accounting cost allocation and transfer pricing? Okay, let's look on the production manager issue. Is the Jason Joseph, which previously Jason actually owned a ownership for 25%, but now it decreases into 8% only. Therefore, as a minority shareholder, he received no dividend. Also, we look at the bonus indicator. Currently, they implement a bonus indicator for a production manager in terms of production cost as a percentage of sales. It is quite unethical action as it does not really evaluate the actual performance because the production manager nothing to do with the sales. Therefore, use the production cost as a percentage of sales is not relevant for the bonus indicator. It reduces the bonus received for the JJ. Also, it may demotivate for the employee in that department. Next, we look at the shipment issue. The CHIA International claimed the quality issue, and they refused to pay the shipment for the Caribbean Brewer. However, JJ, the production manager, is adamant the quality consistency. He believes that the quality is good. Also, there is no complaint lodged by any of the customer. Hence, there is a possibility of false allegation. Okay, so what actually is transfer pricing? According to a definition, it is a accounting practice for pricing transactions within and between enterprise under common ownership or control. Okay, so IAS 24 related party transaction mentioned that a company with same parent company is considered related party. So therefore, the Caribbean Brewer and CHIA Caribbean is actually a related party because they have the same parent company, which is the CHIA International. Okay, so we look at the related party issue. The first one is a bottle deposit. The Caribbean Brewer collected $8 per case on the refundable bottle deposit on domestic sales and the exported Tiger beer. However, it does not apply on the exported CHIA beer. For information, the CHIA beer only exported to CHIA Caribbean. And this issue is actually quite significant because for the $8 per case, it contributed 60% from the total sales. The next issue is the sales discount. The CHIA Caribbean received a sales discount from the Caribbean Brewer, which it normally sells for $50, but it only sells at $25 for the CHIA Caribbean. So the issue that I mentioned just now actually is a transfer pricing, and for the JJ one is the cost allocation. Okay, for question 2. Given the wording in figure 5 with respect to the taxation of related party transaction, to what extent the Caribbean Brewer vulnerable to tax reassessment? Okay, this is an extract for the figure 5. It is regarding the income tax at section 23. So the summary of this income tax act, when a company that produced less profit than those who could be expected, therefore there need to be reassessment. Whether there is any additional profit should be deemed. Okay, according to the section 23 income tax act, the resident corporation is a Caribbean Brewer while the non-resident corporation is CHIA Caribbean. So we need to identify whether the resident corporation and the non-resident corporation they have any relationship or unethical transaction to reduce the profit earned. Okay, let's look at the sales versus the production cost. The first line will be the sales and the second line will be the production cost. As you can see, there is a significant rise of the production cost, which is actually is not aligned with the sales. The production cost rise around 100%, while the sales only grow like around 50%. Therefore, it is not tally and not relevant. Okay, the main factor of the rising of the production cost is because of the refundable bottle deposit. The bottle deposit issue we mentioned just now, right? The company did not charge the bottle deposit to the CHIA Caribbean. So initially, the refundable deposit they have no effect on the accounting record, but when the company did not charge the bottle deposit, they need to expense it, and therefore it lower the profit because higher production cost. When the profit is lower, the tax base also lower. Next is export of JIA beer. All the export sales are made to JIA Caribbean. The export are shipped directly to the island where the beer will be sold. However, the invoice is issued by JIA Caribbean. This is because the JIA Caribbean is a tax-free jurisdiction. So this is believed that it is an action of tax evasion. Okay, question 3. What are the implications of the compensation of the board member to the reporting of the CEO? So before we answer the question, I would like to introduce about the agency theory. According to this theory, the agent represents the principal in a particular business transaction. In this context, CFO will be the agent, while the principal is the shareholder. So what the CEO required to do is they need to maximize the profit for the shareholders. From the issue that I mentioned just now, the transfer pricing issue, the unethical sales discount, and so on, it actually jeopardizes the minor stakeholder benefit. First, we look at the employee, the JJ. He is forced to adhere with certain policy such as a business indicator, and also there is an issue regarding the shipment. Then the second one is a shareholder. Shareholder also receive no dividends for the years. Also, there's a fashion issues such as they're having a loss of ownership of or control. They're having lost effective voice in decision making because they only own a small number of shares. Therefore, the share amount is not significant for them to do certain decision making. Also, denying access to information on business affairs and decision. And lastly, their benefit was harm. Obviously, the transfer pricing was aimed to profit or benefit the majority shareholder because they want to escape from the tax or they want to benefit other corporation, which is the parent company, the JIA International. So CFO, he need to be ethical and make reasonable judgment. So how can he make the improvement? I categorize into 4. First one is from the cost perspective, whether the bottle deposit are relevant, needed to be charged or not, and the sales discount. Is it necessary to give a sales discount, and what is the rate for a sales discount is suitable? Next one is the quality. The CFO need to check on the quality to avoid from the complaint and false allegation. Next one is a bonus. The CFO required to develop a new performance indicator in order to measure the actual job performance. The last one is a corporate governance. The CFO need to safeguard the right of the minority stakeholder by developing certain policy. Okay, so that's all from me. Thank you for listening.